Hey everyone, in this video I want to talk about how to trade options like a professional. So we're going to go over some of the do's and some of the don'ts of a professional trader. Then we're going to jump into the platform and take a look at some real life examples. But first I want to talk a little bit about how I got started trading. When I first started, I was introduced to an individual who was at the time trading stocks and futures. And I was really fascinated with the markets, trying to get started, wanting to learn every bit I could. So I was looking stuff up on the internet and buying courses and all kinds of stuff. But I met this guy and I begged him to let me come to his house to teach me how to trade. And so he was gracious enough to do so. But he wasn't trading options. He was, like I said, he was trading stocks and futures, and it was all directional. So he was looking at support and resistance and trend lines and technical analysis and a bunch of garbage that doesn't really work. And so that's how I got started. And so I was doing really everything wrong at that point. I was trying to average into positions. So I'd buy a certain amount. If it went down, I'd buy some more. And if it went down, I'd keep buying more. And that works part of the time until it doesn't, right? If you've ever done that, you know that can work some of the time, but when it keeps going and going and going, it'll come back and it could wipe out all of your gains that you've made to that point. So eventually you're always going to get caught because there's always going to be an extended move at some point or another. Warren Buffett said, the markets can stay irrational longer than you can stay solvent. The markets can stay irrational longer than you can stay solvent, meaning they can have the market can have moves bigger than you can average into and be profitable in the long term. What we want to teach you to do is to be professional traders. Trade like real professionals do. Hit singles and doubles, stay consistent, and be in this game for the long run. That's the goal, is to take consistent profits out of the market over the long haul. If you're trading a strategy that can work right now but is going to come back to bite you in the long run, then there's really no point in trading that way. You're gambling. You might as well go to Vegas and sit down at the craps table. Okay, so we're going to teach you some real, true, and tried principles here. So one example, and this was my last real blunder trading, so I'm kind of getting vulnerable here with you guys, and I want to share with you something that happened to me, and this was the most recent one. So at the time of this video, it's March 16th, 2017, so I want to share with you something that happened to me in 2014. And at this point, I was trading mechanically. I was trading all the strategies that I currently teach. The premium selling, iron condor, strangles, butterflies, that kind of stuff. But I decided to take a flyer, and the flyer that I took was in oil, in the oil futures. And what I did is, it was right around this area here. I don't remember the exact date, but sometime in September of 2014. And if you watch this box here, it'll show you the date as I hover my mouse. So oil was bouncing around between $90 and $95. And remember, just before that, it had gone up over 100 and kind of stayed over 100. And there was a lot of talk about, will oil go to 200 or 300? I mean, that was kind of a lot of the headlines in the paper. And so I thought, boy, when it got down to around 90 to 95, I thought, man, this is a no-brainer. I'm gonna buy oil, and I'm gonna hold it until it bounces up. Well, as you can see from the chart and looking in hindsight, what happened is the bottom completely fell out of oil, right? It went from 90 to 45 in the matter of a few months. It got cut in half in the matter of a few months. And so what I did, and part of this was ego, and part of it was just being stupid, frankly. But what I started out, I just had one contract in oil. It went down, and what did I do? I kept buying. I bought some more here, I bought some more here, I bought some more here. After this drop, I thought, this has got to be it. It can't go any lower. I bought some more here, and it just dropped a bit. By the time that things were said and done, I was holding over, I think it was over 10. It was 11 or 12 oil contracts. And for my account size, I mean, had a decent size account, large 6-figure account, but even for that size account, that's way too big. When it was all said and done, guess where I got out of the trade? Where I just kind of called uncle. I couldn't do it anymore. It was right at this. It was below 50, and I ended up losing over $115,000 on that trade. Wiped out all my profits from earlier in the year, plus some. I was able to bounce back in 2015 and gain all that back and have a nice year, nice profit that year. But think about what that does to your ego. Think about what that does to your psyche when you're trading. I lost over 6 figures in one stupid trade after I'd been trading very mechanical and very good. So I tell you that to give you an idea of, you cannot let these markets take control of you. You cannot throw good money after bad, because it will come back to bite you eventually, like it did here. So I wanted to share that with you, to share that, you know, even once you think you're a disciplined trader, I mean, this was only 17, so this was only 3 years ago, and I haven't done anything stupid since. Not saying I won't ever do anything stupid again, but you know, I swore after that trade that I would never average in, and I would never get too large, and I haven't since then. So anyway, just wanted to share a little bit about that. Let's jump into some of the do's and don'ts of a professional trader. So some of the don'ts. Don't try to guess market direction. Okay, if you're a purely directional trader, then you better have directional trades going long, going short, going you know, different directions and offsetting each other, because that's what professionals do. You're not just going to be all long or all short or trying to go in all one direction. So don't try to guess market direction, because market direction is simply a 50-50 bet. You know, if we take a look at SPY, I put in here just buying 100 shares of stock. So that's the only box I have checked here. So if you look at the visual graph, this is a 50-50 bet, right? Look at it, 51.7 up, 48 down. So essentially close enough. It's a 50-50 bet. And so you can do the same if you decide to short the stock. It simply flips it, right? And most of the trades that we take are kind of in that 45-day range. So let's just move this to April 22nd. You can see, you know, between now and 4/22, today's March 16th, so a little over a month. In that time frame, this gray area represents the one standard deviation move, either up or down. So nearly 70% chance that the stock is going to stay in that range, and it's a 50-50 bet. Okay, this is when I had a big epiphany, is when I finally visualized this and realized that what I was doing was nothing but a 50-50 bet, and probably less than that once I got my human nature and emotion involved. Okay, so stay away from purely doing directional bets. When implied volatility is low and we don't have some of the real high probability opportunities available, then that's typically when I get a little bit more directional, just to stay engaged in the market. But I'm still taking short positions and long positions to help offset each other. Don't just try to be one directional. Second, don't trade too big relative to your account size. Okay, I showed you how I got slammed in oil by getting too big relative to your account size. If you want to stay in this game, if you want to trade for the long term, you have to trade small. And you may not, based on your account size, you may not be making the type of profits that you want, but you have to do it until your account grows, or until you can put more money in. Otherwise, eventually it's going to come back to bite you. So stay small. I go over this in every one of my courses, and I emphasize position sizing and keeping your risk to a minimal size. Third, don't buy out of the money options. Okay, let's go back to SPY as an example. So if we're going to buy options at all, which I very rarely do, it's always going to be in the money options. And here's why. If we buy, and I talk about buying kind of an 80 to 90 delta range. So if you look at the 248 strike right now as an example in SPY, what you'll see here is the 248 is going to be pretty deep in the money right here, so about an 85 delta. So between 80 and 90 delta is where I want to stay, and the reason is because then you have very little time decay. Look at the difference between the pink and the teal line is pretty small. So we're talking about 100 bucks here, 120 bucks. Is the theta decay that if price were to stay right here and volatility were to stay right here, that's the amount of theta decay we're working with, okay? That's manageable. It's still less than a 50-50 probability, but this can be used to hedge portfolios and different things. So this is a manageable amount of theta decay. We've got to be right fairly quickly to minimize that, but it's pretty manageable. What you don't want to buy is out of the money options. So if we take a look at an out of the money option, and somewhere around this area, let's say the 20 or 19, 22 or 19 delta, and we buy an out of the money, the 231. So look at what this does to our graph. Okay, this was our in the money. So you just have a little bit of theta decay, but still better probabilities than if you do this, which is out of the money. Now, if we move this to our break even, look what that does to our probabilities. We have almost an 85% chance of losing money, right? And that theta is just going to be working against us. And so it's tempting, you know, why would I buy this option for over $10 when I can buy this one for under $1? Well, this is why, because you have a very low probability of success of this ever happening. This is a lottery ticket, okay? We don't want to trade like a lottery ticket. We want to trade with high probabilities, and the probability is more in our favor. Okay? And then lastly, as a professional, don't let trades go all the way to expiration. Okay? We want to manage these, and that gets into the do's. We want to close our winning trades at a percentage of max profit. If we wait all the way to expiration, what we're doing is we're leaving risk on the table, and the amount of reward that we have left to get out of that position is very minimal. We want to close winning trades at a percentage of max profit and redeploy that capital into other high probability trades. Okay. The second thing you want to do as a professional is sell options when implied volatility is high. Okay. Sometimes I get the question, well, so if implied volatility is low, then I should be buying options, right? Well, that's a time that you could potentially just buy a directional put or call, depending on the underlying. But you would never buy to open an iron condor or buy to open a strangle or a straddle. And the reason is because it sounds logical on paper to do that, but it doesn't work that way. In fact, and we've done studies and showed videos on this in the past, but you can actually make money selling options, selling strangles, selling straddles, selling iron condors when implied volatility is low. You just don't have as high of probabilities, and you don't make as much money as you do if you sell it when implied volatility is high. So the way I like to think about that is, think about a professional hitter in baseball. They can still hit the ball if they swing at a pitch that's out of the strike zone, right? I mean, they can still get a hit. But the best hitters in baseball, the best home run hitters, the best hitters for average are the ones that wait for their pitch. And so if you can have the patience and only sell option strategies when implied volatility is high, you're going to be much better off in the long run. And that's what a professional does. Okay. Next, you want to beta weight your positions to SPY. Okay. You want to manage your positions as a portfolio, not each one individually. Now you want to trade and you do want to adjust and manage each individual position, but you always want to know what the effect of that position is going to have on your overall portfolio, and you want to beta weight your positions to SPY so you have a clear idea of which direction your portfolio is slanted. And I'll go to the platform and show this, but before I do, because this ties in, you always want to keep short delta in your portfolio. Okay, as premium sellers, which is what we are, we're selling iron condors, we're selling straddles, we're selling strangles, and even calendars are a theta decay type trade. Even though you buy a calendar or you buy a butterfly, those are still short premium trades. So on most of those strategies, you're going to benefit from a contraction in implied volatility, right? We want to sell it when it's high, and we benefit when the implied volatility contracts. Okay? So when does volatility contract? Volatility contracts when the market goes up, right? So if we take a look at SPY, and let's just look at some examples here. So in this period here, look what happened when implied volatility was going up. What was happening to the market? It was going down, right? When implied volatility was going down, the market was going up. So the implied volatility compared to the stock market is almost always inversely correlated. Stocks go up, volatility goes down. Volatility goes up, stocks go down. Market goes up, volatility goes down. Okay, it's always an inverse correlation. And so when the market goes up, volatility is going to be contracting. So that's going to be helping our short premium positions, right? But if the market goes down, implied volatility expands, that's going to hurt our position. Okay, so it's very critical that if you have positions where you're selling premium all over the place in different stocks and ETFs and indices, it's imperative that you keep short delta in your portfolio. Okay, so let's go to the monitor tab and take a look at monitoring the positions by beta weighting to the SPY. So all you have to do in Thinkorswim is click the box here and beta weight it, and then type in SPY, and that's going to beta weight your positions. So what that does is it shows you your delta, and let's uncheck it to take a look first. So this shows the delta relative to itself. So this is natural gas, corn, wheat, apple. So this is the delta of that position in relation to each one of these symbols. But these are like looking at apples and bananas and oranges and strawberries and grapefruits and pineapple. So it's all different types of things. And so to compare apples to apples, to understand exactly what you're looking at from an overall portfolio perspective, you want to beta weight that to something. And what I like to do is I like to beta weight it to SPY or to the S&P 500. Now I know that based on all these different uncorrelated positions, I have a negative 157 deltas in my overall portfolio in just these here. Okay, so I've got minus 158. So that means if the SPY moves down $1, I'm gonna make $158. If the SPY moves up, I'm gonna lose $158. So that's what I mean by having short delta in your portfolio. Okay. So the other thing I wanted to show you on here was directional bets or directional trades. So as I mentioned, you don't want to be just purely directional, but you know, I have short S&P futures, I have long gold, I have short bonds. So I know how these are positioned in my portfolio overall. So I'm not saying don't take directional positions. I'm saying make sure you understand how they fit into your portfolio overall. So I've got VIX and Tesla and Amazon and bonds and gold and S&P. And overall, I know that my short delta in these positions is minus 1,300. Now that's a little bit more than I like to carry typically as far as short delta, but the market has been just explosive to the upside, and so I am comfortable being short from a directional standpoint this mini delta. If that gets out of whack, if that gets too high, I know that I need to either get long another position or I need to let go of some of my short delta to adjust that. So you're going to trade and adjust each position individually, but you need to know exactly how that fits into your overall portfolio. Okay, it's very important, and this is what professionals do. This is how you manage your trades in a portfolio standpoint. And so very critical. I hope this was helpful. If you do have questions, please let me know. Otherwise, we'll see you in the next video. If you'd like to learn more about the different strategies that we use to make consistent returns, come see us at NavigationTrading.com. We've got a ton of free resources, including the navigation watch list, which is a list of the most profitable symbols to trade for each type of strategy. We've got the volatility indicator, which you've seen on my charts. You can download this directly to your thinkorswim trading platform. And we've got a free options course called Trading Options for Income, which is a step-by-step guide to get you making consistent trades right away. We look forward to seeing you there.